Hi, good afternoon. On behalf of Infomerics Ratings, I once again welcome all of you to this discussion on the August 2020 RBI's monetary policy. As some of you would recall, we had made a presentation last month on various aspects of the Indian economy. Given the kind of overwhelming response that our first presentation received, we have decided to make it a regular feature. In this series, today we have a discussion on the bi-monthly monetary policy of the Reserve Bank of India. Let me begin by providing some kind of a perspective to this policy statement by the RBI Governor, Mr. Shaktikant Das. This policy was formulated in challenging circumstances. The incipient recovery discernible in June 2020 after the disconcerting crash of April 2020 seemed to have plateaued because of restrictive conditions in many states. Widespread deceleration was manifested in industrial activity, contracting PMI in both manufacturing and services, tepid construction activity, sharp contraction in cargo and air passenger traffic, etc. However, there does seem to be some kind of a silver lining. Agriculture certainly seems to be doing well, with monsoon rains starting strongly in June and July. However, it has to be realized that growth in agriculture alone would be grossly inadequate to keep GDP growth positive. But the agriculture sector has important forward and backward linkages and is an important determinant of demand revival in rural areas, which can make or mar industries such as FMCG, fast-moving consumer goods, tractors, etc. India's animal spirits remain fragile despite the economy reopening. Rapidly declining private corporate investment, growing manufacturing inventory, poor performance of service sector, increased unemployment in organized sector, and sharp fall in corporate tax revenues cause concern. Loan moratorium and household and corporate sector pressures have caused revenue shortfall and liquidity crunch. The sharp credit offtake of banking sector has been further aggravated because of COVID-19, which hampers the growth process. There has been a significant decline in corporate rating and sovereign investment grade rating. Given these trends and tendencies, GDP in FY21 is certain to take a hit because of muted domestic activity and weak external demand. Against this kind of a backdrop, the RBI's Monetary Policy Committee unanimously voted for keeping the policy repo rate unchanged at 4% and the reverse repo unchanged at 3.35%. Now let me come to the stance of the monetary policy. The MPC also decided to continue with the accommodative stance of monetary policy as long as necessary to revive growth, mitigate the impact of COVID-19 while ensuring that inflation remains within the target zone in the spirit of whatever it takes. Fresh infections have restrained a resumption in activity, with states enforcing localized lockdowns. Several high-frequency indicators have lost steam. because of statewide lockdowns to curb the rampaging virus. The recovery of the rural economy is expected to be robust, buoyed by the progress in Kharif sowing. Manufacturing firms expect domestic demand to recover gradually from Q2, but consumer confidence turned more pessimistic in July relative to the preceding round of the RBI survey. All these forces and factors are certain to lead to a contraction for the first time in 41 years. While the MPC justifiably held that in an environment of unprecedented stress, supporting macroeconomic recovery assumes primacy in the conduct of monetary policy, it refrained from giving a specific GDP growth number. Rural areas are witnessing green shoots and are likely to perform much better than urban areas. Monsoon and the far-reaching agriculture reforms are widely expected to drive the rural economy. Government support to the rural sector has ranged from grain transfers, direct cash transfers to women using Jan Dhan accounts, increased crop procurement, PM Kisan payments, and increased allocation for Narega. India's central government expenditure to GDP ratio at 13.04% in 2018-19 is among the lowest in the world. This inadequate central government expenditure largely stems from the low tax to GDP ratio of 10.9% in FY19. But given the various dimensions of COVID-19, a stronger rural sector can mitigate the ongoing economic damage caused by the crisis and not obviate it completely. In view thereof, the GDP is certain to contract in FY21, driven by muted domestic activity and weak external demand. Let us now come to the inflation outlook. In line with the time-tested objectives of the monetary policy, the RBI accords high priority to price stability, well-anchored inflation expectations, and orderly conditions in financial markets while sustaining the growth momentum. Domestic food inflation has remained elevated across most economies post-pandemic. Headline CPI of April-May 2020 are obscured by the spike in food prices and cost push pressures. High food inflation, together with a rise in fuel prices, personal effects, transport and communications, has also led to high inflation. The MPC expected headline inflation to remain elevated in Q2, with inflation easing in the second half, aided by favorable base effects. There also could be the emergence of a more favorable food inflation outlook because of the bumper Rabi harvest, favorable monsoon, and moderate increase in minimum support prices of Kharif crops. Non-food inflation outlook remains uncertain as high petroleum prices could result in broad-based cost pressures. The prices of fuels were inflated by higher excise and value-added tax, and that added to the inflationary pressure. The inflation rate of fuel and light rose from 2.69% in June to 2.80% in July. Volatility in financial markets and rising asset prices also pose upside risks to the outlook. The MPC said, and I quote, "A more favorable food inflation outlook may emerge as the bumper Rabi harvest eases prices of cereals, especially if open market sales and public distribution offtake are expanded on the back of significantly higher procurement. Nonetheless, specific risks to food prices remain. There is a real concern that retail inflation could well breach the 6% mark in July and August. If inflation averages 6% or higher for 3 consecutive calendar quarters, there would be the statutory invocation of Section 45ZN in the RBI Act 1934, requiring the governor to explain to the government this breach. This would place the entire top management of the RBI, as also the MPC, in poor light. This issue is also compounded by inadequate monetary transmission. The MPC held that since the National Statistical Office (NSO) did not have the inflation rates for April and May, but gave the imputed index, the CPI figures for these 2 months marked a break in the CPI series, where imputed inflation for April and May be used. Inflation breaches 6% for 2 consecutive quarters. But there is a strong case for the MPC in not considering the imputed CPI from the point of view of monetary policy. Another issue of great concern is the clear divergence between the wholesale price index, WPI, and CPI. The WPI showed deflation in April, May, and June at 1.57%, 3.21%, and 1.81%, respectively. The CPI was calculated in April on the basis of price quotes of 59.5% of the items to be considered. This increased marginally to 63.1% in May. For example, the inflation rate in recreation and amusement was higher at 5.7% in April and 5.5% in May from 4.4% in March. However, these activities were absent in April and May. The index of this service was also higher at 146.5 points in April and 146.8 points in May against 143.7 points in March. Inflation numbers were higher than the ones calculated by the NSO because food items which have a higher weightage of over 45% in the CPI were consumed more than they are done normally. The RBI also announced a major restructuring package for stressed MSME loans. The governor announced a Rs 10,000 crore additional special liquidity facility for the housing sector and smaller NBFCs. The RBI allowed lenders to implement a resolution plan for corporate loans without change of ownership. Also, MSME borrowers were allowed restructuring of debt. There are also very significant measures in respect of one-time restructuring of loans. The RBI governor said, and I quote again, "It has been decided to provide a window under the June 7th Prudential Framework to enable lenders to implement a resolution plan in respect of eligible corporate exposures without change in ownership as well as personal loans, while classifying such exposures as standard assets subject to specified conditions. Unquote. The regulatory approach has basically to be dynamic, proactive, and balanced. In addition to the provision for restructuring of large corporate loans and personal advances, MSME borrowers will also be allowed to restructure their debt provided they were classified as standard on March 31, 2020. This window will be available till March 31, 2021. This restructuring scheme is restricted to borrowers facing COVID-19 stress. The framework shall not be available for exposures to financial sector entities as well as central and state governments, local government bodies, accounts which were in default for not more than 30 days as of March 1 will be eligible for such restructuring. All other stressed accounts will have to follow June 2019 framework for resolution. Subsequently, a panel was set up under KV Kamath to finalize this scheme. A one-time restructuring scheme for MSMEs would only be applicable to MSMEs with outstanding debt up to Rs 25 crore. Restructuring plans for such MSMEs will have to be implemented before March 31, 2021. For accounts which are restructured under these guidelines, banks will have to set aside additional provisions worth 5% over and above what they already hold. The one-time restructuring scheme was originally announced in January 2019 and then extended again in February 2020. These guidelines were extended further to provide additional support to MSMEs owing to COVID-19 and to harmonize restructuring guidelines across borrower categories. Further, the RBI announced several measures primarily aimed to revive economic activity and to reduce the stress on borrowers post-pandemic. It has also broadened the scope of priority sector lending to include startups, increased limits for renewable energy, increased the target for lending to small and marginal farmers and weaker sections, and assigned higher weight for incremental priority sector credit in the identified districts. In respect of retail loans, a one-time restructuring scheme has been announced. All loans extended by lending institutions to individual borrowers will be covered under this framework. Lenders will not be allowed to restructure loans they have granted to their own personal staff under this framework. Accounts classified as standard and not in default for more than 30 days as on March 1 shall be eligible for restructuring. Lending institutions may allow rescheduling of payments, conversion of any interest accrued or to be accrued into another credit facility, or granting of moratorium based on an assessment of income streams of the borrower subject to a maximum of 2 years. Gold loan guidelines have also been significantly revised. The RBI revised its guidelines for gold loans by increasing the loan to value LTV ratio from 75% to 90% to help stressed borrowers unlock more value. The enhanced LTV ratio will be applicable up to March 31, 2021. Thereafter, the ratio will reverse to the earlier limit of 75% for all fresh gold loans sanctioned on and after April 1, 2021. This measure, like the Shakespearean quality of mercy, will benefit both the borrowers and the banks. While it would help borrowers facing a resource and cash crunch, banks will also be happy to swell this portfolio because of gold's relative safety and its consideration as a safe haven. There were some expectations of the RBI cutting interest rates further, but the MPC might have been dissuaded by the rising retail inflation and inadequate monetary transmission. The CPI rose to 6.09% in June from 5.84% in March, breaching the central bank's medium-term target of 2 to 6%. Further, the MPC had already cut repo rate by 40 basis to 4% in May. Thus, the MPC had already slashed the repo rate cumulatively by 115 basis points in the last 7 months. There were also factors like the repo rate being close to the effective lower bound, the steady downward movement of deposit rates, and a fear of foreign outflows in case of a reduction in interest differentials. Consequently, there is limited space for further monetary policy action. Assessments about future rate cuts range from an incremental 15 basis points to 50 basis points depending on the headline CPI inflation's glide down to 4%. But the MPC is stressed that it must be used judiciously to maximize the beneficial effects for underlying economic activity. Let me now come to our concluding observations. Gazing into the crystal ball and predicting the shape of things to come is fraught with dangers and uncertainties. Given the certainty of macroeconomic contraction, quadruple balance sheet problem, infrastructure companies and banks, plus NBFCs and real estate companies, the issues of credit risk, credit crisis, and credit risk aversion will occupy the center stage. There are also other factors like weak oil prices, positive outlook on balance of payments, benign inflation outlook, lower global rates, and easing liquidity by major central banks. All these factors augur well for yields in India. However, overhang of large supply of government securities, central and state, especially at the longer end, excess SLR investments within banking system, and sharp reversal in gold prices, high near-term inflation continue to be key risks. Thus, in view of the evolving macroeconomic situation and the growth-inflation trade-off, the governor took the right call by holding the rates steady at this juncture. Thank you very much. Thank you.